Hello everyone and welcome to today's session. So today we are going to start with chapter number 4. Before I proceed to chapter number 4, please if you have any doubts with respect to any of the chapter that we have discussed till now, please ask. Okay? So don't hesitate how small or silly doubt it can be. Don't worry on that. If you have any doubt with respect to any of the part of any of the chapter, you can ask. You can write on the chat, or you can ask, unmute yourself and ask. Okay, I think we have one doubt in essay 620. Okay. Uh, if work of actuarial valuer is used, is the auditor expert or a management expert or both? See, Mega, the only question is who is appointing actuarial valuer? If it is being appointed by management, it is if he's working based on the management terms, he's the management expert. If he is being appointed by auditor to validate the valuations performed by the management. See, the valuations, the preparation of the financial statement is the role and responsibility of the management. Now let's say management is giving you management has hired actual valuer. He has given a number. Okay, after doing the calculations, he has given the number. Let's say whatsoever number it is for the valuation. Now whether auditor is hiring him to verify that number, or whether the actual valuer is the one who's deriving that number, that will decide whether he's a management expert or an auditor's expert. See, if he's deriving the number, means he is helping management in presenting and preparation of the financial statement, he should be management expert. If he is helping auditor to validate that number which is given by the management, he is an auditor's expert. So accordingly you need to think of. I hope I have answered your doubt. Okay, great. Any other doubts? Anyone else? Any other doubt? No? Okay, great. So we will proceed with the chapter number 4. Okay. Now we will discuss chapter number 4 today, and on the Monday, that is 15th September, there will be one more session on chapter number 4. We will discuss on that. But I hope you guys have read through the chapter, because that is very, very important. Okay. And this is the fundamental, you can say one of the base fundamental chapter for the audit. This is the base thing. Like when you do a audit, materiality, risk assessment is the very important thing when it comes to the audit. Reason, because when we do a audit, we say we do a risk based audit. It's not something you go jump into the financial statement and you randomly start doing the audit. Okay, I like trade payables, I'll do the audit of trade payables. I like fixed asset, I'll do the audit of fixed asset. It doesn't work like that way. It don't. So in that case, you need to first of all assess what is the risk, and then you jump on the financial statement by identifying the relevant risk, and then you go and do the audit. That's a risk based audit approach. Now, when I talk about risk-based audit approach, the fundamental thing for the audit, risk assessment becomes by default very important part. Till that time, I don't know the risk, I cannot do the audit. And you cannot assess the significance, the level, the amount, or materiality of the risk till the time you are aware about the materiality concept. So first you need to be aware about the materiality concept. Then you can make yourself, understand what risk is there, whether it's a significant risk, whether the risk is of material misstatement. Then you will proceed ahead. So materiality, risk assessment are the main important parts of the audit, and that's why it becomes very, very critical. Okay. Now I will show you something, a picture, and then we will talk about that particular picture. If you can understand that picture, that is your chapter number 4 to a some extent. Okay. This is the image. Okay. This is the image that I was talking about. Now, This person standing in the rain, okay, has an umbrella with him. So, can you tell me how it is related to audit? Can anyone tell me how it is related to audit? Anyone? Anyone? How it is related to audit? Why I'm showing you this picture? No? Okay. See, what happens in audit? If you are going to do an audit, what happens? There is an organization. Okay. There are risks in the organization's process that you identify, and then you check whether you have a relevant control in place of that or not, and based on that you decide whether this control is working or not, and then based on that you identify the risk, categorize the risk. We have seen, remember, a table where we discussed about, okay, what kind of risk is it is there, whether it's the inherent risk is high, whether the detection risk is there or not, remember. So accordingly it becomes very important for that, for a particular auditor to understand how the organization, how the controls, how the processes are being set up. So by taking this example of this particular image, I'll tell you something. Assume this particular part, the rain that I'm talking about, is the risk. The rain which is there is the risk itself. What is the risk? Can anyone tell me what is risk? What is risk? Anyone? Basic question for the audit. What is risk? When I talk about risk, what is risk? Very good, Hetal. Yes. Yes. Very good, Nia. Risk. Okay. And apart from this image, risk means what could go wrong. On a normal sunny day, rain can be a risk. Yes or no? On a normal sunny day, for me, rain is a risk. So, rain or the risk is nothing but what could go wrong. Now, here, if I talk about risk, it is nothing but what could go wrong. Now, on a normal sunny day, rain becomes a risk. Now, to protect that risk, we have an internal control. We have a control in place. This control is nothing but this umbrella. This umbrella is nothing but internal control, because this person knew that there is going to be a risk. To protect himself from the risk, he took an umbrella. You can say this is an internal control to protect oneself from the risk. Okay. Now, still, still there are chances that some of the risk might escape the umbrella, the internal control. Yes or no? So this risk which I'm talking about, the rain, is nothing but your inherent risk. Okay. But the risk which is still passing on, this risk which is still crossing the umbrella, is, you can say, a chance of a kind of a detection risk, that your controls might not be able to prevent or detect the control risk, that your controls might not be able to prevent or detect the risk or misstatement, basically. So in this umbrella there could be a scenario where you have a control risk, and control risk is nothing but the chance that how much umbrella cannot stop. Okay. Now if you see in this umbrella you have few holes. These are nothing but, you can say, deficiencies in the internal control. These are nothing but the deficiencies in internal control. That means that internal control will not be able to prevent or detect the risk, the chance of control risk that we are talking about. So probability of having deficiency is the control risk, a kind of a scenario where I'm talking about. This person, I would assume he's the organization. So organization, you have an umbrella internal control, you have deficiencies in the internal control. Now comes the very important thing, that the part which is missing, which is still crossing the internal control, the rain which crosses the internal control, and the rain then which is beyond the umbrella, passing from these deficiencies, is your, you can say, risk which is left after the controls. Materialized risk, risk which has materialized, kind of. So this is the raindrops which are coming from the hole, the risk which internal control cannot stop. Could be a materialized risk. This materialized risk, basically, I'll just make it readable for you guys. Yeah. This materialized risk can give rise to a very important thing, that is your risk of material misstatement. From this materialized risk, so this is nothing but the chance of materialized risk, and from this we can get the risk of material misstatement. Sorry. From this we can get the risk of material misstatement. Okay. This is, if I talk about, is nothing but how actually the risk works. This is how actually the risk works. So you have a risk, inherent risk, okay, which is the rain, which will always be there. There are chances of rain. Now, still, to protect yourself, you have an internal control to protect yourself from the inherent risk. But the deficiencies in the internal control are of such nature that they are allowing the risk to pass on. Okay, means you have something called the basically chances of having deficiencies. When I talk about chances of having deficiencies, that is nothing but your control risk. Okay, that is nothing but your control risk. That, okay, after having the umbrella also, I will not be able to stop the risk because of the deficiencies. There could be a scenario when your umbrella is small. At that point in time, you will say that, okay, internal controls are not adequate to cater the risk or to mitigate the risk. Okay, so you need to have an appropriate size of umbrella, plus you need to have an umbrella without holes. Okay, then only it will work, otherwise it will not work. So adequate internal controls, you need one thing, you need the internal controls which are adequate to be proper without any holes. Okay, then only you can reduce the control risk, otherwise you cannot reduce the control risk. And what is left out is your risk of material misstatement. You can say chances of materialized risk. Now, from this risk of material misstatement, you may get another material misstatement. Once there is a risk of material misstatement, then there are chances that there will be material misstatement itself from that risk. This is the overview of the risk I'm talking about. Okay, overview of the risk. Now the question comes is that how we need to figure it out, or how we need to incorporate in our audit. Okay, how we need to incorporate this in our audit. See, when I say risk, before starting the audit, when we do a planning, we do acceptance and continuance, at that point in time we identify what could go wrong. Like in this scenario, rain. Like in our audit also, we will say where the rain can come. Simple. what could go wrong in our financial statements, which areas, where, in which process, what could go wrong. Once we identify that, we identify, do they have umbrella, do they have internal controls, adequate internal controls, proper internal controls. Adequate, when I talk about size, numbers to cater that. Then when I talk about proper, without deficiencies, whether they are operating effectively. Okay, once I understand that, I define, okay, now that's really good, they have the internal controls, there are less deficiencies, means the control risk is lower. Then I proceed to check, now there was a risk. Okay, there was a risk. For example, if I talk about a particular city where you have a high chances of rain, so you will say, if that city is a city where you get a lot of rain, hypothetical example, Mumbai. Okay, that chances of rain are very high, in, like, very frequent, like rain can happen, so the inherent risk will be high. But when I talk about a city where you hardly get a rain, for example, Jodhpur, Jaipur in Rajasthan, somewhere, maybe they are getting less rain. So having a rain in those cities, chances are very less. So inherent risk is lower. Okay. Now, for example, in Mumbai, if the inherent risk is high, the person is carrying bigger umbrella. Okay. And that umbrella is appropriately fine, like there are no holes in that, then you will say that control risk is lower, risk is high, so the chances of getting risk materialized would be somewhat medium or lower side, because we have a good amount of umbrella to protect. But still there are, water droplets which may pass on from the edges of the umbrella or something like that. Or if the rain is from different direction, you cannot stop the rain, so you cannot fully mitigate the risk at all. Okay, so there are chances that the person still will get, wet in the rain, and whatever rain will fall on this person is your misstatement. This is nothing but your misstatement. Now, having said that, like, if the rain chances are less because of the city, because of the weather, you have an inherent risk which is lower, then you may have a bigger umbrella. Okay, let's say, for example, inherent risk is lower, you have a very bigger umbrella which is appropriately fine, means you have a high controls in place, control risk is also low. Then the chances of getting wet here, like this in this picture, like, the person might not get wet on a sunny day, is very very low. So I would say the risk of having a material misstatement is very less. This is how, first of all, I identify whether there's a risk of material misstatement or not. Any doubt? Any doubt? Any doubt? Okay. So there are few things that we understood now. Inherent risk, we understood the control risk, we understood the risk of material misstatement. That's why when we talk about the formula for the risk assessment, it talks about these factors. Like audit risk is nothing but the combination of all these things. Yes or no? So what was the formula for the audit risk? Anyone? What was the formula for the audit risk? Absolutely correct. So the formula for the audit risk is nothing but inherent risk, control risk, and the detection risk. Now, what is the detection risk in this image? If you are seeing this image, if I say you, okay, identify where the person is getting wet, if you can detect that, that is a, you are identifying the misstatement. But the areas where you miss to identify a person getting wet, like in this image, like, the water droplets are falling, if you miss that particular area, in that case it becomes, there is a detection risk. The auditor was also not able to identify from where the water was coming from the umbrella. That is a detection risk. That is not detecting a material misstatement, risk of not detecting a material misstatement. Are you getting a point? So I'll show you one another image, and then we will discuss in that image also, like in parlance of that image. See this image here. You have some people looking after the umbrella, looking after where the risk is there, like where is the problem and how much water is coming from the umbrella. Similar example, you have a risk which is inherent risk. Okay, you again have a deficiencies in internal control. These are the deficiencies. You have internal control, the umbrella. But this time the auditors are here. These are the auditors who are inspecting not only the you know umbrella, but they are also inspecting that, okay, what is the process, like rain comes on the umbrella, then where it goes, from where it can go down, everything. So everywhere they are understanding each and every process. So if I say they are understanding one aspect of the umbrella, no, you need to understand all the aspects of the business process. Then only you will be able to understand where the risk is there, like from where the risk is coming. So they will understand, okay, this is the place where the risk is coming. This is the place where the risk is coming. So rain falls like this, it goes from the umbrella, these are the holes, everything. So they go and check each and every point to understand the risk. And let's say, for example, if they miss out something, that is the audit risk. If they miss out a particular deficiency, if they miss out a particular area, like for example, if no one is looking at this particular area where the water is coming, that's nothing but your audit risk. So at the end, if they say, oh, no, there are three big holes, four big holes, they missed very big one, audit risk. Are you getting the point? So this is what we need to implement on the ground when we are doing the audit. Any doubt? Okay. Now, very important part that I need to discuss is about materiality. Is about materiality, the concept of materiality. Very interesting one. Because till the time you are not able to understand materiality, you will not be able to understand which is the risk of material misstatement. So to understand the risk of material misstatement, you need to understand the materiality. Okay. Can anyone tell me what is materiality? When I talk about materiality, what is that? What is material? If I talk about the definition of material, what is material? How do you determine this is material, this is not material? How? How do you determine this is material, this is not material? Anyone? Come on, quickly. Based on some benchmarks, whether an amount or item is having higher chances of misstatement. Okay. Hmm. But if I talk about, if you have to determine a particular amount of misstatement is material or not, so how do you determine that? Like what you do? Let's say I have a misstatement of 1 lakh rupees. If you want to check whether this 1 lakh rupee misstatement is material or not, what you will do? What you will do? Anyone? Based on the size of organization, other factors. Okay, will detect. Fine. Anyone else with a different answer? What can influence a decision of stakeholder? Very good, Hetal. Yes, absolutely correct. What could influence the decision making of the users or the readers or the stakeholders? That is material. Okay, so the materiality is something that you need to understand. Okay, if this can change the decision making of the reader, it is material. That's the concept of materiality. Okay. Now to calculate and to evaluate that, we use the mathematical formulas. Okay. If this goes beyond this, it becomes a material. Because I know 5% or 3% of this particular amount will definitely change the decision making, economic decision making of the reader or the stakeholder. Okay. So that is the important part that we need to understand. When I talk about materiality, you need to think from a point of view, okay, what could be very important and which can influence the decision making. Okay, now that is materiality, which can influence the decision making of the user. Perfectly fine. Yes, understood. Now the second thing I want to understand, if I talk about materiality, yes, that is there, then in that case, do you think we should have only one materiality? It is something that we should have only one materiality. Yes, no. Yes, absolutely correct. Materiality can change based on the area. Absolutely correct. Yes. So now we will understand something with respect to the materiality first.
No, sir. We have the performance materiality also. On the performance materiality, we have the trivial materiality as well.
Yes, absolutely. Absolutely. So when it comes to the materiality, okay, we will understand something, some important concept with respect to the materiality. Okay. Now, which are these important concepts? Is first of all, overall materiality. Few terms we will understand. Overall materiality. Now, when I talk about overall materiality, it is nothing but the level of the materiality that is determined on overall financial statements. If anything goes beyond that, your financial statement at a overall level are materially misstated. Okay. So when I talk about overall materiality, it is the materiality level established at the financial statement level. So this is the materiality at financial statement level. If anything beyond this level, the whole financial statement are materially misstated. It's kind of a scenario, you can say that. Then comes the performance materiality. Can anyone tell me what is performance materiality? What is performance materiality? What is anyone?
Sir, performance materiality, the auditor will fix below the overall materiality level. And accordingly, the auditor will go through the audit. And in the performance materiality also, they will fix the thrivable materiality, which is the amount, the bar minimum, the minimum that level the auditor will not verify it. So, example, the performance materiality is fixed 5 lakhs per transaction. Thrivable materiality would be 10,000 per transaction. Below the 10,000, the auditor will not verify. If the cumulative basis, they will check whether that tradable material also is needed to check or not.
Yes, absolutely correct. Yes. So it is the level of materiality that you set below the overall materiality. Now, as you said appropriately, the use of this materiality comes like it is not the time, till we will wait if we find overall big misstatements at the financial statement level. No. See, for example, at a financial statement level, 1 lakh rupee might not be relevant. Absolutely. It can happen because the financial statement numbers are very big. But for the areas, certain areas, you could have a smaller number. For example, let's say in a financial statement, which is a retail store, multi-chain retail store, okay, multi-brand chain retail store, okay, the retail stores which are there, like branded retail stores. Over there, you don't have any data, like you don't have any trade receivables because everything is dealt in the cash. So the two things which are very important in the asset side of their balance sheet will be inventory, number one, very big inventory. Number two, fixed assets like the buildings and the showrooms that they will be having. So these will be the two things which will be very, very important. And the third, yeah, if they have any cash balance, bank balance, FD investment, all those things. In liability side, they might have a very good amount of trade payables. They might have loans and advances. So I'm not talking about the liability then. Okay. So let's talk about the asset. We know for a fact that they will not have a very good trade receivables. Now, let's say for example, when I'm doing the audit, trade receivables might be material, but not at that much as the inventory or the fixed asset might be. So I might have a lower performance materiality for the trade receivables in that scenario compared to what I may have for the inventory. Reason because inventory in such kind of scenarios could be, let's say, in crores, and where I'm talk about the trade receivables, it could be in lakhs. It would not be appropriate for me to have a materiality which is in crores to apply on the lakhs number. As a result, I could have a smaller materiality, a lower number than the overall materiality to detect individual material misstatement. To detect the individual material misstatement, it may happen that small amounts which are there in your financial statement, for example, they have a smaller loans, they have a smaller trade receivables, they were smaller, for example, provisions. Okay, there are chances these small amounts might contain misstatement, which if I joined, it may become big. Simply, I'll go this particular part, this image. Big ones, okay, fine. Big holes are fine over here. But for example, if there are small one, okay, small parts which are not appropriate, which are allowing water to pass, in that case, what will happen is if I ignore these particular segments on the basis of materiality, because my materiality is higher, it may happen that very small part, very small, will allow cumulative a higher amount of water to flow. I may say these are very small, these are not coming under the materiality level. I am just looking to the segments where I have a bigger portion from where the water can flow based on my materiality, but that is incorrect approach. Because overall materiality at the umbrella level, yes, I am focusing on bigger picture, but it could be a scenario where smaller areas can allow very multiple smaller areas can allow a lot of water. For that, I have a performance materiality, that how much small areas I can look into, how I can look into those, a level to detect individual misstatement, okay, which we can overlook if we are only focusing on the overall materiality. So it is something you could say lower, smaller than the overall materiality. Clear? Any doubt with respect to the performance materiality? So you can say lower level than overall materiality, sorry, lower level than overall materiality to detect to detect uncorrected misstatements, or to detect misstatements which might not be bigger enough, but cumulative they can go bigger. Okay, now this was your overall performance materiality. Usually we have one more limit. Usually we have one more limit in materiality level, like some have, some don't have. Okay, uh, we call it like some call it as a you can say sad level, some level or whatever, but it is a level. Okay, you can say some or sad level. I'll explain what is some or sad level. Now what is this is, these are the things which are lower, very lower, which will not affect your opinion. So at the statement level, financial statement line item level, or at any process level also, they're very smaller. Okay, anything below this I can ignore, I can accumulate. So you can say a level below which you need to accumulate the misstatement. Okay, you need to accumulate the misstatement. This does not impact opinion. Now what is this? When I say said, it's a summary of adjusted differences, or when I say sum, it's a summary of uncorrected misstatements. Okay, these are certain terms which are actually used. This is nothing but summary of adjusted differences, or when I talk about sum, is nothing but summary of uncorrected misstatements. Okay, so some more sad level are being maintained in a particular organization. Trivial level, or yeah, absolutely correct. Trivial level also can be called, like different names there are, but below which they does not impact the opinion. We just accumulate them till that time they cross or they reach to a performance materiality level. Okay, or if anything goes beyond this particular level, let's say if I'm accumulating, and it goes beyond this trivial level but not till the level of performance materiality, then it raises a question, should, like, how it will impact the opinion. Okay, very very important part, that these levels are used in planning the audit. Any doubt? Any doubt? No. Okay, great. Now, one important thing that we need to understand is how to determine these amounts. We understood what are these amounts, but how to determine, that is very important. Okay. So, if I ask you, if you want to determine this overall materiality, if you have to determine this overall materiality, how will you determine? What you will do to calculate this amount?
Sir, we need to check the benchmarking. The benchmarking, which means based on the profit or based on the asset liability. Say example, if the particular division the last year is a profit, this year also profit. So based on the profit, they can based on the material level, they will fix the percentage of that profit. So example, if they say 100 crores profit, the 10 percentage of the items to be checked like that. If there is no benchmarking available on the profit, say example last year it loss, 1 year is profit, the fluctuating, then the benchmarking cannot be done on the profit side. So we have to look at the other side as well. You need to check what is the asset, what is the based on the liability, whether can be done the benchmarking. Based on that, we can do that.
Very good. Yes, absolutely correct. We will calculate as it a percentage of some benchmarks. Yes, very good. Okay. Anyone would like to add to this, like with respect to the benchmarking, percentage of PAT, revenue, EBITDA? Yes. How will you calculate benchmarking? How will you determine the benchmark? How will you determine the benchmark? Anyone? How will you determine the benchmark? No? So if I ask you, this is the overall materiality, we will apply a benchmark, we will calculate based on the percentage of that benchmark. But at the end, the question comes is how will you determine the benchmark? Anyone?
Sir, it's based on the profit, the margin we can take it. Out of that, we can fix a benchmark. If the profit is fluctuating, the last year is profit, this is a loss, then the benchmarking cannot be done on the profit side. So we need to check at the alternative way how we can do the benchmarking. Say we can take consider as a asset. What is the asset total asset value? In that asset value, how much we can fix the materiality. Say example, the total asset is 100 crore, out of which 10 percentage we can test, or based on
Hmm.
like that we can do that benchmarking, sir.
Okay. Any other thing that you consider for benchmarking? Like once example you gave, if they are is a profit, you will consider profit. If the company is not having adequate profits or it is a loss making, you will consider something else. What are the other factors that you take into consideration when you do a benchmarking, when you select a particular benchmark? Anyone? Any other factors that you consider for benchmarking?
Sir, can we take industry data or similar company data to check the comparison or to set the benchmark?
Okay, industry data. What else? We'll keep in mind the user's knowledge and area. Okay, user's knowledge, company, other companies in the segment. Fine. Anything else based on the industrial norms? Like what could be the industrial norms? What are the industrial norms? Like some of you answered industrial norms as per the industry. What is that? Areas in which risk of material misstatement is assumed to be more.
Similar
I'm talking.
company, similar
Hmm?
company and similar line of transaction and similar line of profit, those things we need to check when we are using the other company data.
Mm, okay. Uh, Still not, I would say. Still not. Reason because uh, what see benchmarking is one thing, but apart from benchmarking, what is else that you would look into? For to determine about the entities benchmark that you need to select for the materiality. See, comparison of the other entities is one, but how will you determine that what entity is taking which benchmark? For example, I can tell you 10 different entities, but how will you determine what benchmark they are taking? Effectiveness of the internal controls. I don't think so. Yeah, effectiveness is one thing, but still, there are few factors that we need to discuss that are really important when it comes to the benchmarking. For materiality, anyone? Okay. What we'll do is we will understand with an example of a financial statement. Let me take to you a financial statement, example financial statements, and then we will decide the benchmarking. How to determine the benchmark for the materiality. Okay. Uh, just a minute. Let me give me a minute. Yeah. Okay. So we have a financial statement. You have a financial statement in front of you. Okay. All amounts are in lakhs as of now. Understand that. And this is a financial statement for 2025. This is the P&L that you have. Okay. And it has profits and everything mentioned in it. Revenue, employee benefit, total profit, then profit for the continuing operation. Everything is there. Example one. Then you have this is the balance sheet, both years. Okay. Now tell me, this is the one, the P&L you are looking at. What is the benchmark that you will take for the materiality? What benchmark you will take for the materiality? If you are talking about profit, which profit? Profit before tax, profit from continuing operations, which kind of profit you are talking about? Profit, I have a total other comprehensive income, then I have a total comprehensive income for the year. Which level I will take for the materiality? Anyone? Think, take a minute, think on this. This is a practical thing you need to understand. How you will determine the benchmark. It is written that you need to take profit, everything fine. We have read it, but how in practical you will apply? Anyone who knows the answer?
So we will consider the profit before tax for the continued operation separately and discontinued operation separately. According the for that separately, we will fix the performance materiality benchmarking, taking considering the profit level.
Profit before tax you are talking about.
Yes, sir.
Okay. Profit before tax. Why profit before tax?
Because the income and expenditure based on that before profit, right? That is what I'm thinking, but I'm not sure whether it is a before profit or according to me, it should be the before tax.
Okay. Okay. Anyone else? Anyone else? No? Okay. See, I will discuss, like, we will understand which level we will take. In this particular scenario, as you correctly said earlier, that we need to check about what is the more appropriate way and more appropriate number for the entity. Like, this is the financial statement. What is the main thing that you will first look into? Which is the thing which can impact your economic decision? Leave everything apart. What is the part which you can say that, okay, it will really impact my decision making? If I change a number, let's say if I change a number of total tax expense or profit after tax or profit from continuing operations, will it impact more? Or if I change the profit before tax, will it impact more? What do you think will impact you more here? Anyone? We will select the figure like from the FS, like PBT, turnover. We will keep in mind the user's knowledge, areas and which risk of turnover, profit and loss. Okay, fine, good. Net profit before tax, yes, absolutely correct. So we are talking about now in terms of decision making. See here in this particular financial statement, if the decision of the user is very much critical for this point of view, this one, profit before tax. Why? This tax expense is directly related to this. So obviously, I know it's a company. The tax will depend upon the profit they are earning before tax. Okay. So if the profit before tax changes for me, then I'm pretty much sure that is going to impact me. Now, here I could have tax rebates, a lot of things. That's why I'm not worried about that. I may be worried about more profit before tax. Sometimes, and why profit before tax? Because this shows what company is earning in operations. So this can tell me about the company's operations. This is the dummy numbers. Don't go on that. But here I can get an overview that okay, what company is earning from its operations, and that becomes very important for me to decide. That's why profit before tax. Are you getting the point? Why profit before tax? Why profit before tax is the appropriate benchmark in this scenario?
Okay, sir. Got it, sir.
I could have taken, see, some might say you need to take sales. But the question comes is why I would take a sale when I have an appropriate benchmark of profit. I would only take sale as a benchmark in this scenario if instead of this profit, it would be a loss. Let's say, for example, somehow there was a loss in the current year. Last year it was a profit, but this year they have a loss because of XYZ reason. In that case, profit are not continuous. I will not rely upon the profit. I will take the revenue from operations as a benchmark, provided the revenue are stable. So whatever stable item is there, I will take that as a benchmark. If let's say the loss was because benchmark, overall materiality benchmark. Now I have one more example for you guys. We can discuss that also, which is with respect to another company. Example company has a good financial statement. We have a P&L for that. Okay, this is the one. Now tell me what materiality benchmark you will take here. This is the company. You have a revenue, you have expenses, profit before tax, you have tax expense, profit for the year period, all those things, and then you have a balance sheet. Now this is the balance sheet. If you see, I'll just align the numbers some so that you can easily see. They have a plant property equipment, very good amount. They have current assets, they have equity, non-current liabilities, everything. What you will take. Now this is the balance sheet you have. What you will take as a base for your overall materiality benchmark. Anyone?
Sir, firstly, we will go with profit before tax. If the profit is negative or a profit is volatile, it's very high low. In that case, we will go with revenue. But first, we will go with profit on profit before tax.
Okay. Anyone else? with some different answer? Profit before tax. I will not go for profit before tax in this particular scenario. In this particular scenario, I will not go for profit before tax. I'll tell you the reason. I will go something called EBITDA. Do you know what is this?
Earning before interest, tax, depreciation, and amortization.
Why I'm going for this? Can anyone tell me why I'm going for this?
By going this, we can know what is our cash transaction, means operational cash profit.
And why I'm worried about cash here? I was not worried about cash in earlier. I'm worried about cash in this. The reason for that is this thing: manufacturing. Manufacturing will show me this is a capital intensive. Yes, I do have a very good amount of depreciation and amortization sitting in my books. I have a very good amount of finance cost sitting in my books. And that's why, remember, I showed you the balance sheet where I told, like, okay, very good amount of non-current asset, plant, property, and equipment, very good amount of loans and advances. So for me, the first thing with respect to the business will be something which is not, kind of amortized, notional depreciation, because depreciation is going to be high. It's a capital intensive industry that is not going as of now from their pocket. Are you paying depreciation to someone? Answer is no. In the earlier scenario, I went and, took a profit before tax because the depreciation was not that much. It was some solutions private limited service industry. That's why I said, okay, fine, let's go for profit after tax, because they don't have that much of depreciation that the employee benefit and other expenses are. So accordingly, my decision making will differ. Like here, if you see, your non-current assets and the current assets are equal, almost equal. But in this scenario, if you see, your non-current assets are almost more than double, like triple of your current assets. That becomes, or that, forces me to change my benchmark. That's where I will change my benchmark, and from profit before tax, I'll move to the EBITDA. So I need to check the industry. I need to check the volatility. I need to check what is the more relevant factor for determining the benchmark. Clear? Any doubt with this?
Clear, sir.
Okay. So once I determine my benchmark, based on that, I take a decision, and then, basically we determine the overall materiality, then performance materiality based on overall materiality, and the sum and set level. Accordingly, everything will flow. Any doubt till now? Any doubt? Okay, so we will go with your study material now. We will go to the study material. See, this is chapter number 4. These are certain things that we will go and focus upon. Audit and risk-based audit that we have just now seen. We were talking about till now. Internal controls is something we will understand. Components of internal control, review of systems. All with these things will go one by one. Okay, in order to understand the risk-based audit approach. Okay. So first, starting with the materiality and the risk assessment, we understood about the materiality in detail, the concept of the materiality in as per SA 320. If you go SA 320, it is the same that we have discussed till now. Okay. So once you understand the materiality, now you can perform the risk assessment. For that, you need to identify the risk, like inherent risk, control risk, detection risk, and then you, whatever is left, is the audit risk. Accordingly, which is, even after the detection risk, is the audit risk that we discussed in detail with an example of man with an umbrella. Okay. So these are the definitions of the inherent risk, control risk, detection risk, and like whatever we have discussed. Okay. Whatever we have discussed, it's a definition over here. And this is the relationship that we discussed now. Again, very good formula of the risk of material misstatement. You guys only answered to me what is the formula for the risk of material misstatement. Okay. Okay. Now, this particular formula of risk of material misstatement is, given on basis of inherent risk, control risk, and the detection risk. The next thing we need to understand is the risk are at two levels. When I talk about the risk, okay, the risk is at two levels, risk at different levels. So one, you have a risk at overall FS level. Second, you have a risk at assertion level. Can you tell me what is the risk at the assertion level? Can anyone tell me what is the risk at the assertion level? Anyone? Risk at the assertion level.
Sir, it is assertion level means it is management giving implicit or explicit representation regarding any item of financial statement, such as in case of P&L item, we check occurrence, completeness, accuracy. So for checking that, there some level of risk remains. So that will come under assertion level risk.
Okay. Do you really think that we need to go and check the risk at the assertion level, or we only need to check the risk at the FS level?
Sir, we need to check both the levels, sir. Assertion level as well as the overall financial statement level also we need to check. And assertion level, as he likely said about that, in case of asset, whether the existence is there or right is there, whether it is a completeness is there, all these things we need to check on what level they are assessed.
Okay.
We need to, yeah.
Let's go to the example of financial statements, and then we will understand what is assertion level and what is your risk financial statement level. Okay. Now we have this financial statements with us. Okay. I'll just remove the markings. Okay. Now we'll focus on the inventory here. Okay. So we have an inventory balance, which is given in this particular example over here. Now tell me what is the risk at the financial statement level and what is the risk at the assertion level for this inventory. With an example. If I talk about this inventory, what is the risk at the assertion level for this inventory and what is the risk at the financial statement level for this inventory? Anyone? See, this is the part we need to understand. Like, we can say assertions, we can read assertions, but in actual, how to identify these assertions?
So on the financial statement level, if you look at last year is the 5,950. This year is 6,200. So there is an increase in it. So we need to check on the financial statement what is the percentage of increase. That is one point. On the assertion level, on 6,200, the current year only we will check whether the 6,200 is correctly sitting or classification or occurrence and right. All these things we need to check the each level.
Can
That
you
is.
give some example of the risk at the classification, occurrence, or other levels? Like example, what is the risk? Example of the risk. Okay, Mega, very good. Anyone? Like, what is the risk? I know the assertions. We have read, we have gone through the study material. We know the assertions. Very good. What is the risk at? Can you give an example to explain the risk at that assertion level?
Sir, account
Sir, it,
classification, presentation, and disclosures, whether it is anything is wrongly done.
Okay. Ankit, you were saying something also?
yes, sir. Risk in inventory will be such as ki like loss of inventories or such as ki undervaluation of some of the inventory, overvaluation of some of the inventories. And in this 6200 we can verify like this 5950 opening plus purchase, then minus cost of goods sold, then this 6200 should come. If it is not coming, then there is like a incorrect.
Okay. Can anyone tell me the assertions which are there for this particular inventory?
So it could be overvalued or undervalued the inventory or obsolescence inventories is still looking at placing under the inventory, which is no use.
Okay, let me show you some examples with respect to the assertion level for the inventory. Okay. Very good, Mega. Yes, you are correct. So if I talk about some examples of the inventory assertion level risk for the inventory, okay, I already have. Let's say, for example, existence. The risk is that the inventory on the books does not actually exist. That's the risk at the existence level. It might be stolen, damaged, scrapped, entirely fictitious. That is a risk. Very good, Sanjay. Yes. Again, rights and obligations. A common risk is when I say rights and obligations, that you have a right on that inventory. A common risk is someone else's inventory is lying in your warehouse, or you have given your inventory on consignment which is not there. So you have an inventory which is not with you, or someone else's inventory is lying with you. The company possesses this inventory but does not own it, or inclusion of a goods held on consignment. Sometimes it may happen that you have someone else goods lying in your warehouse. You are saying it's your inventory because it will show in existence, but you might not have a right on that. That is the assertion level risk. Completeness, omission of the inventory. Like if the goods in transit, like the Mega, the way you were saying, if the goods in transit might not be appropriately disclosed, you will never come to know about its existence. And the completeness. Valuation, overvalued, undervalued. Because of like you have some different formula to recognize the value of the inventory. NRV or something. So you like, for example, the first thing I will understand the inventory, the risk of the inventory at the financial statement level. How will I see the risk? Sorry, how will I see the risk of inventory at the financial statement level? Is by understanding with respect to the materiality. Let's say my overall materiality in this particular scenario. Hypothetical example as of now. I'm not saying it is a correct approach, but hypothetical, I'm going with the profit before tax. I take 5% of PBT as overall materiality. Okay. Now, 5% of this, if I talk about, will be somewhere around
161, sir.
huh, 161. Okay. So 166. Okay. 166 will be my overall materiality. Now this is in lakhs. Anything below, anything above 166 is material for me at the overall level. Now, first of all, I will see whether financial statement has an inventory which is material at the overall level. This is 6200, way beyond 166. So definitely it is material at the overall level for me. Definitely it is material at financial statement level. Now I need to understand the risk at the financial statement level. The risk at the FS level will be if it is incorrect. If this 62 is incorrect, it is a very big issue for me. Now I need to understand what are the chances of inventory being misstated materially at the financial statement level based on my past experience. So I will give a overall level of classification to that. See, it's a manufacturing industry. So for manufacturing, two things are very important: inventory, which includes raw material, work in progress, and finished goods. And second one is the way that you handle your capex, fixed assets. Okay, sales, everything are there, but these are the special areas in case of manufacturing. Inventory and the FA are the very important areas, because inventory because you are manufacturing that, FA because you are using that in FA to manufacture inventory. So for me, this will become a significant area at the FS level. Significant risk area at the FS level. Again, the amount is very high also. If you see, half of the current assets, half of the current assets are inventory. Okay, that is the financial statement level. At the assertion level, these are the risks which I will evaluate: existence, rights and obligations, completeness related risk, valuation related risk. Now, this is the risk. Okay, this is a risk at the assertion level. In front of that risk, I need to map few things. Inherent risk level. Okay, what is the inherent risk based on my experience? Like, for example, what are the chances that existence is not there? Okay, I'm asking about the chances of risk in existence, chances of risk in rights and obligation, chances of risk in completeness, chances of risk in valuation. And what is the risk? This. What could go wrong when I say this? That valuation existence is not there. What is the chances of that? Now, chances you can determine based on two things. Number one, based on your past audit of this particular company. Number two, management's integrity. Remember, like at the time of acceptance and continuance, we checked about the management integrity. Shown at the top, ethical value, all those things. Okay. Third is your experience from auditing the similar kind of company, some other company, but in the same industry. Let's say, for example, you are already, audited a company which is into manufacturing of same product in India. So what is your experience from that? So from that, you can identify the chances of risk. Way, for example, I'm talking about Mumbai, rain in Mumbai. Okay. So one way you can understand how much it's going to rain is if you are living in Mumbai, you will know it can rain anytime. So that is your experience. Let's say, for example, you have been to another city, Kolkata. Over there, you know that, okay, it's same like Mumbai. The weather of Kolkata and Mumbai is same. It rains in Kolkata any day, any given time, without any intimation. So you can, figure it out. Okay, Mumbai will also be same. Now, for example, there is a third one is also weather reports. You might check the weather reports, okay, weather evaluations, or you may read somewhere how the weather of Mumbai is. That is the industry knowledge. You do research about the industry. You do, kind of research about what is the major risk areas in the particular industry or a particular type of companies, which is the common areas now, auditors are facing. That is the key audit matters or the qualifications of the companies which are audited by other auditors. You can identify from that. You can also generate your knowledge from that. Okay, which are the key areas? that they are facing, it's an issue for them, either in qualification or key audit matter. This is how you can generate the experience and you can build your knowledge about the inherent risk. And then we have discussed in the past also that once you have the inherent risk, and then you can go ahead. Any doubt? Any doubt?
No, sir. Clear, sir.
Okay, if no further doubt, then we were talking about basically the risk calculation, the risk identification at the assertion level and at the financial statement level. Let me go back to the study material. Now, see, when we talk about SA 315, we talk about identifying and assessing the risk of material misstatement through understanding the entity. And over there, you need to understand the risk at the assertion level and the financial statement level. This is the assertions which are there. I know you have already read this. We have discussed this multiple times. Now also we discussed occurrence, completeness, accuracy, cutoff, classification is for the transaction related P&L kind of items. Existence, right, obligations, completeness, and valuations are for the balances, inventory. And presentation and disclosure related are occurrence, rights, obligation, completeness, classification, and accuracy and valuations. Okay, so these are certain assertions at which at these levels we need to assess the risk. Now tell me one thing, when I talk about this particular part, assertions, do you think all the risk at the assertion levels are similar, are of same level? For example, if I say risk of occurrence, let's say sales, let's take an example of sales for this particular one, sales. Okay, now tell me the risk of occurrence, the risk at the occurrence assertion for a sale will be similar for the completeness in completeness or accuracy or cutoff or classification. So if I say occurrence, significant risk for me for sales. So by default, the completeness, accuracy, cutoff, classification will also become significant. Yes, no?
No,
Yes,
sir.
sir.
It will vary, sir.
Okay. I think Ankit, you are saying yes. Samanathan, you are saying no. We have more answers who are saying yes. Okay. So the actual answer is no. The reason because I'll again show you with an example. Not necessary that you have similar risk for all the assertions. For example, sales. Okay, sales. So risk for assertion occurrence is that the recording fictitious fake sales. Now I know for a fact that management is ethical. They have a very good controls, and they are something who do not tolerate any kind of such things. So I have more, they are more in, there is a more integrity with respect to the management. So recording fictitious sales or inflate revenue by doing malpractices, I have not seen till now in this management based on my audit experience. I may mark this as a low. Completeness. Sales are understated. Yes, there are some complex accounting policies that they are adopting because of which, because again, it's a manufacturing. Okay, they do sell on consignment basis. So there are some scenarios where they do not record sales on time because of their, some processes which are designed too complex. Okay, or recording sales at a later period because they are not good at maintaining information or data. So it may happen the completeness might not be there. So I may risk this as high. Accuracy, again, incorrect price and quantity. For example, it's a manufacturing. So price might not be, issue for me because they are using ERP. But quantity can be because if they are using some specific kind of goods which are made in kgs, some, let's say for example chemicals, or for example some colors or something like that, which are very difficult to measure. Quantity is a part which can create a problem. Could be a mix, high, medium, low. Cutoff. Again, when I say completeness is the issue, it may impact cutoff also. So I may again go for a high. Classification. Now, company has one or two line of products. Misclassification of other income as a operating revenue, very less chance because they have a very less other income. So I may classify as a low risk. So it is not necessary that all the assertions go hand in hand. You may tag a particular assertion, a risk at a particular assertion at a low level, and you may tag risk at another, assertion level high. That is perfectly fine. That is the assessment. This is the risk assessment that you have to do. Now, this is just a shallow risk assessment that I have done for your example. But when it comes to the real audit, we do a detailed level of risk assessment. For example, if they have multiple uh, stream of revenues, for example sale of this kind of product, sale of this kind of product, sale of this kind of product, then if they are not homogeneous, we actually go and do risk assessment for each different type of sale. Sometimes they have a overseas sale, sometimes they have a local sale, bifurcation, local overseas, sale with related parties, sale with unrelated parties. We do different kind of risk assessments for these different kind of sales, and again at the assertion level. So this is how deep risk assessment you need to perform before doing the actual execution of the audit. So it is not something just like, okay, from tomorrow I'll start the audit, give me the sale invoices, I'll start ticking. No, that is not the approach in actual which is being followed for the audit. Clear? Any doubt?
No doubt, sir. Clear.
Okay. So assertions, so these are the risks we need to identify at the assertions level. So again, auditor, the first is at the overall financial statement level, and then it comes to at the assertion level or class of transaction level, account balance or disclosure level. Class of transaction means sales, as I told you, overseas sales, local sales. That's a class of transaction. Account balance, inventory, disclosure related to inventory, something like that. Okay, so you need to identify a risk with specific assertions at the class of transaction, account balance, and disclosure. Okay. Once you do that, then only you will be able to understand the overall. See, I need to follow, multiple approaches when I do a risk assessment. What I do is first I decide at the overall level. First, I decide at the overall level based on my pre-audit or pre-planning information. So when I'm at the pre-planning level, I get some information. I do a overall level of risk assessment for the entity. Remember in audit plan, we did some overall level of risk assessment. Then you go at the assertion level and see what is the detail. You do planning activities, gather information, all of things. Once the risk assessment at the assertion level is done, you go back again to the overall level and you see whether any change is required at the overall level also not or not. Okay, so first you come top to bottom and then you again go bottom to top in the risk assessment. Okay, so this is the overall level. Then you decide at the inventory, cash, payables, revenue, expenses. Then you do at the assertion level, and based on this, I again go back and reflect at each level it is appropriate or not. Okay, so you need to assess the significance of the risk, impact of occurrence, chances of occurrence, materiality. Based on the materiality, determine the likelihood of the assessed risk. Now see, when I say low, medium, high, high, medium, low, high uh, medium, or low is product of two things. One is likelihood, and it's a magnitude. What is likelihood?
Occurrence.
Chances of occurrence. Probability. Chances of occurrence. What is magnitude?
How many times
Okay.
or number of times of occurrence.
Okay. Anyone else? Magnitude. So it's not only the number of occurrence, it's the impact.
Whether how the impact is, whether it's a high or low or medium. Yeah.
So what will be the impact if the occurrence happen? Impact at the time of occurrence. Let's say, for example, I have a risk of, let's say, fictitious. So chances of occurrence is very low. That they are very low chances of they will record fictitious expense. Magnitude is, if let's say, for example, this company is building huge heavy machineries, okay, very big machineries, they are manufacturing that. A single transaction of fictitious sale could be of very big magnitude, because they are building very heavy machinery. It's not small products and kgs they are selling big machineries. So fictitious sale, chances of occurrence is very low, magnitude is very high. If it occurs, very high magnitude. So I need to check what is the magnitude impact at the time of occurrence. Based on that, based on the likelihood and based on the magnitude, I determine what will be the risk for that particular assertion, for that particular class of transaction, account balance, or disclosure. The impact, which is the magnitude I'm talking about. Okay. Then you need to identify the degree of significant risk based on these things. High, medium, low, there I'm talking about. Okay, this is the risk assessment you do. This is the risk assessment you perform, risk identification. Clear? Any doubt? Okay. Then once you do that, you understand with the management. See, for this, all these things, now you need to do inquiry. It is not something that you can buy your own identify. You need inquiry, you need to do some detailed analysis of the data. You will check internal controls, a lot of things is here. This is the part where I'm just only talking about inherent risk. Now comes the control risk, then comes the detection risk. You need to same way evaluate the control risk and the detection risk. For control risk, you need to understand the management. Okay, management, tell me what internal controls you have, their routine, how they are designed to prevent or detect the errors, manual, automated, any unique characteristics of that risk. This will give you about inherent risk. This will give you information about control risk. Okay. So once you decide the inherent risk and the control risk, then you can go and decide what testing you need to do. Then only you will be able to identify proper risk of material misstatement. What is risk of material misstatement? Is nothing but inherent risk
IR
into
into CR.
CR. Yes, that's a risk identification. Once you identify the risk of material misstatement by IR and CR, that's a risk assessment, risk identification you are doing. This is how in actual the risk assessment identification is done. And yeah, like these are the examples I would recommend you to read. uh, Risk based audit approach we have discussed now multiple times. Like, you focus on the risk when you do a audit. Okay. So again, risk assessment is one of the part, risk responding and reporting. These are the other part. Risk assessment, just now we understood in detail. We will discuss now about the responses to the risk and then risk reporting. Okay, all these things we will discuss now in some time. But till risk assessment, I think we are fine. We are good. Any doubt for the risk assessment part? Any doubt for the risk assessment part?
Sir, can you explain difference between assertion level and overall financial statement level with the example of fixed asset? Like in case of fixed asset, how do we identify risk at this both level?
Okay, let me show you with an example. Okay, let's say this is a fixed asset I have. Okay, this. Now, when I talk about risk at the financial statement level for the fixed asset, that totally depends upon how I see fixed asset, whether they are material for this entity or not. Now, fixed asset is the biggest major component in the balance sheet. So, and this is a manufacturing inventory entity. So, fixed asset by default, it will become a significant area for me. By default, it will become a significant area for me because one, materiality, anything in the fixed asset can trigger the whole balance sheet to go on toss. Significant area. Okay. If you see the total assets that I have, total assets are of 48,000, out of which 32,000 is only fixed asset. See the significance. Now I need to understand at the assertion level the risk. Again, assertions are going to be same. First of all, existence. What is the risk at the existence level? That fixed asset will not be present in actual on the ground. They are there in my books. Either they are scrapped or it were actually fictitious. They were never bought. Only book transactions were done. Existence of the fixed assets. Now, based on my experience, I will decide high, medium, low, likelihood, and magnitude. Rights and obligations. Sometimes what happens is we have a joint manufacturing unit. Okay, 2 or 3 companies runs a joint manufacturing unit, or they might have a common manufacturing unit. At that point in time, outside India, it's a very similar. You can go and buy a manufacturing plant or unit on rent, fully set up manufacturing plant line. Let's say, for example, this happens more onto the package and food industry. Let's say chips, potato chips. Okay, so some people have installed a plant for making potato chips. They have a 3 different production lines. One line is given to X company, one line is given to Y company, one line is given to Z company. Shared manufacturing. What they are showing? Are they showing that the manufacturing line which they have taken on the rent is theirs? Rights and obligations. Sometimes they have taken machinery on rent for a specific kind of manufacturing. Are they showing it is their machinery, plant property, and equipment, or it is on rent? How they are showing it? Either they are showing under the lease or how it is being reflected. Rights and obligations. Completeness. What if the machinery which was you can say gone for repair and maintenance? Sometimes you bring heavy machinery for manufacturing special items, and if there is any issue in that machinery, you cannot get it repaired at your plant or factory. You have to send back to the manufacturer outside India for the repair and maintenance for overhaul. At that point in time, it becomes very important. How do you ensure completeness? Simple example, if I talk about airline industry. Airline industry, they have a plant property and equipment. They have a very aircrafts. Now, if there is a issue in the aircraft, they might send somewhere else for the testing, maintenance, all those things. So various tests happens on the aircraft. How can you ensure that they are not missed from the inventory list? Valuation. Tell me, how will you value aircraft? Very big issue. Cost, yes, fine, but a lot of things are then add on. time to time maintenance, what you will capitalize, what you will not capitalize, major repairs, minor repairs, a lot of issues are there. So if it is a airline, for me, existence might not be an issue because I can go and see the airline. Fine. Rights and obligation can be because I might take aircraft on lease, some aircraft on lease. Yes, there is. Completeness, again, I don't think so could be a very big issue. Valuation highest, trust me. What are the minor repairs? What are the major repairs which are required to be capitalized? Minor repairs which are required to be charged? A lot of things can be an issue with respect to a valuation of aircraft. So this is how risk assessment is done at the financial statement level and at the assertion level for fixed assets.
Thank you, sir. It was a very detailed. Thank you.
Any doubts? Any other doubts? Okay. So what we do is, this is the risk assessment part that we have done. After this, we will proceed for the next part, that is your risk reporting, risk response that we need to understand, and then we will go to internal controls. So along with risk reporting, we need to understand internal controls. We need to understand what internal controls are, how they are structured, examples of the internal control, components of the internal control that we will discuss. Okay. Based on that, we will be able to understand how to respond to risk. Response to the risk is done through the internal controls. We will understand that. How to review the internal controls. A lot of things with internal controls that we need to discuss upon. Okay. That's the main area. Then the second area that we will discuss, and then we will talk about more onto the part where we do audit of the internal controls, how to test the internal controls. When we talk about design effectiveness, operating effectiveness, what is that, how to do that. Okay, so those are the things that we will discuss after the break. So let's take a quick 10-minute break. After the break, we'll gather back and go for the internal controls. Okay, let's take a break. Oh, thank you, Ashok. Welcome back. Let's continue the discussion. Now we will understand few things about the internal control and how to respond to the risk. Okay. Why it is important? Reason because when I talk about risk of material misstatement, one portion of that is your risk with respect to the internal controls. Okay. If you have the inherent risk and the control risk, then only you will be able to answer about the risk of material misstatement, without which you cannot. So it becomes very important for us to understand what is the risk of material misstatement with respect to, like the control risk portion in that. We understood the inherent risk. Now we need to understand the control risk portion. Okay. Can anyone tell me what do you mean by internal controls? What are the internal controls? What are the internal controls? What do you mean by internal controls? Anyone?
Internal control in the organization are set up to prevent or detect any material misstatement in the financial statement.
Okay, great. Yes. Uh, can you give some example? Yes, very good, Mega. Can you give some example with respect to internal control, which is there on sales? Internal control, which is there on sales. Anyone?
Sir, internal control is the process of policies and procedures set by the management when the transaction is happening, whether those transactions is happened with respect to the procedure and policies elaborated. In the sales example, if the sale is done on the credit sales, before giving the credit sale, is there any credit limit is fixed upon which how many that say example within how many months they have to return that consideration. So example, if it said 90 days is the credit period is given, whether the payment is received in 90 days, within 90 days. What is the limit? If the limit is fixed 1 crore, whether it is a transaction with below the 1 crore. If it is exceeding 1 crore, then what is the mechanism they implemented as per the policy? There is a limit, authorization limit. There is a maker checker concept. Who all these things they will fix. They will review that internal control whether it is effective or not by themselves. It is a responsibility of the management.
Okay. Okay. Any other example anyone would like to give for the sales, internal control on sales? Very good, Mega. Yes, absolutely correct. See, when I talk about internal control, okay, internal control is basically, you can say, a kind of a system which helps you to detect and prevent a misstatement. Okay, which helps you to detect and prevent a misstatement. Now, how it can basically be designed and how it is basically be is prepared. So we will understand with an example what is the business process, what are the internal controls in a business process, and how to identify a particular business process, or you can say, and how to understand a particular business process, and then how to understand a internal control in that particular business process with an example. Okay. So see, whenever, let's say, understand with an example of sales. Okay, business process example of sales. So how do you see, like, how the sales happen? How the sale happens? Business process. If I talk about how the process works for the sale, anyone? How sale happens, business process. Anyone? Simple sale. Like if I talk about a company, how the sale process is designed. No? Okay. Let me give an example. And I will explain with an example of a flow chart. Okay. So we will understand with an example of flow chart that how actually a sales happen. Just a minute. Just give me a minute. Okay. So here is a sale flow chart, a random sale flow chart. Okay. Not any specific, just an example. So how sales happens is basically it's a three-step approach in which in this particular example given. Okay. You have a customer, you have a sales, and you have a account management. How it happens? Customer contacts the company, like something for purchase, for sale and anything, agrees to take a sale meeting, involves decisions makers, stakeholders. Customer evaluates the solutions and makes the final decision. Okay, then contact is made and customer is qualified or not. They understand the customer, they understand the need of customer, they present a solution, and then customer decides to buy or not. Okay, this is how generally a sale example is there. Now, if I talk about this particular business process, okay, sale business process, what risk do you see over here? What risk do you see in this? Anyone? What risk do you see in this? There are multiple risks, I would say. Number one, the customer which is received could be fictitious. Someone internal is doing that. Agreed to take the sales meeting, discovery and need. Who, like in discovery and need assessment, who is finalizing the assessment? Solution, customer decides to buy, order fulfillment, coordination, solution, whether the appropriate entry of the order is done or not in the system. All these things are there. Okay, a lot of can be there. Customer decides to buy. What if the customer is itself a fictitious someone, internal party who is coordinating? They are trying to siphon the sales. They are trying to siphon the inventory from the company. They will buy, but at the time of payment they will not make the payment. Just an example, yes or no? Okay, so this is how actually a sale and risk assessment is done. You understand by flow chart, and then you decide whether basically you want to go ahead or not, or you identify a risk and then you decide whether this risk is enough for me, material for me to focus on or not. Similarly, I will show you some another example for purchase. So I have another example for purchase. Again, how purchase works is, again, random example I'm talking about. Purchase requisitions are then purchase order is there. Okay, purchase order is then prepared, then purchase order sent to manager for approval. Purchase order then is finally prepared, and then it is sent to supplier. Supplier confirms the order, sends the purchase order, and then purchase order notice is issued. And then purchase order notice, receiving report, tax invoice, they match all the three documents. Based on that, payment authorization and payment request is generated. The same is updated in account payables. Based on payment request, they prepare the ETF file, electronic fund transfer file. Payment approval happens. Then it is recorded in the system. Files are updated. General ledger is updated. Deposit slip check. And then the payment goes from the bank. This is the process. Now tell me, what is the control do you see in this particular process? What is the control that you see in this particular process?
Control such as like purchasing manager is approving the purchase order, and supplier is confirming the supply, giving supplier confirmation on purchase order. So these are control on this.
Absolutely. See here, if I talk about the risk could be this one, this purchase order which is prepared could be incorrect. Incorrect purchase order can be prepared. Yes or no? So for that, I have a control in place here. The control is basically it talks about manager's approval, maker checker control, which is there in the picture. That maker checker control is something which is targeting this risk. Yes or no? So there is a risk, inherent risk, for which I have an umbrella, which is this one. Now then, with respect to the payment, there is a risk that actual purchase was not happen. Okay, purchase was not present, and we are still paying. So payment. So my risk will be payment to fictitious purchase. Okay, or payment I'm doing more than the purchase. The payment authorization which is happening is more, or the payment request which is going, or basically instead of I'm identifying the risk over here. Okay, sorry. Yeah, instead of classifying risk over here, I can say that incorrect payment issued at the ATF level. Now for that, I have a control. The control is this one. Match all three documents. This talks about purchase, then this there is already control on the maker checker. So I get some evidence over here or comfort over here that the purchase order is appropriate. Receiving report. Receiving report is basically coming from the warehouse. Again, there will be some controls. This will talk about existence. Invoice will be sent by supplier. Again, before invoice being input into the system, there are controls. There is a match of all three documents, three-way match. This is a three-way match control. Again, I have a three-way match control which talks about kind of a matching, segregation of duties, or you can say maker checker, again, based on which the document it goes for the payment authorization. Now, this risk is being mitigated by this control. Plus, this control is also mitigating this risk. Now, a file update, payment request, again, there is a risk. Now, I don't need a separate control for this risk, because this control, the control at the invoicing level, the control at the receiving report level, the control at the purchase requisition level already takes care for this risk. So you don't need a separate controls for each and every risk. A control can address two different risks. For example, if this control is there, that manager approval on your purchase order, then purchase order is used for three-way match. So some comfort is also being received from this control over this risk. That means there are controls in the process which may address to one or more risk. Yes or no? So what we have done in this example is, there was a risk, there was a control. We mapped the risk against the control. Now the important part to understand over here was, a risk can be mapped to multiple controls. A risk can be mitigated by multiple controls. To mitigate a risk, I can have multiple controls. Okay. So to mitigate a particular risk, I can have multiple control, I can have one control, like depends upon the type of business process. And this particular part, whole, this particular document that you will prepare later on is known as RCM, which is risk control metrics, where you understand which risk or which control is mapped in front of which risk. And based on that, let's say, for example, each risk over here has a rating: high, medium, low. Yes or no? Remember high, medium, low rating in front of risk,
Yes, sir.
inherent risk. Yes. Now, this control will be evaluated now on two levels: DO, or we call it DE, and OE. Do you know what is DE? I will evaluate this control at two levels, at DE level and OE level.
Detection evaluation, occurrence evaluation.
Not detection, it is the design effectiveness and operating effectiveness. Now, I'll talk about the design and the operative effectiveness of a control with an example. Okay. Let's say the three-way match control is there. This document matches all three documents: receiving report, tax invoice, and the purchase order. Okay. If I want to talk about the design of this control, do you think design is fine? Do you think design is fine of this control?
Yes, sir.
Okay. Design is fine. Okay. Now, what you checked to say the design is fine? What was you verified to say the design was fine?
Segregation of duty is given, like who will approve purchase order and who will approve payment authorization and all those.
Okay. Very good. Yes. Here, when I talked about design, what I did is I went through the control. I said, okay, this control says that three-way match. That means there is an objective behind this control. Why I have a three-way match? To make sure that whatever documents are being processed for payment, whatever invoice is being processed for the payment, should be accurate, appropriate. And the best way to match is I have a three different sources of information: purchase order, which talked about, okay, this is the purchase I want to do; receiving report, these are the goods I received in the warehouse; invoice, which is sent by the supplier, like for the purchase I have done. Now I have a three different sources of information. The best way to validate that do I have an obligation to pay for this purchase is to match all three. Three different sources of information. I will match all the three. If they match, that means everything is recorded fine. I have received the goods. The purchase amount which was shared, or the purchase quantity which was shared, is the same I have received. Perfectly fine. I can go and proceed ahead. I can book the invoice and make the payment. Design is perfectly fine. Yes or no?
Yes, sir.
Now, I will show you where we go in much more detail and say design is not fine with the same thing. So what is a three-way match? Three-way match is nothing but we have a PO, we have a receiving report, or sometimes we call it a GRN, goods receiving note, and we have an invoice. We match all three and then pay for invoice. Very good control. Appropriately fine with the design. Okay. Now I say this control is not good. I say match all three amounts. Now tell me, Is this an issue? Do you think there is an issue in this?
Yes, sir.
What is the
Like in
issue?
this case, only amount should not be matched. Like it should be checked, like whether goods has been also received or not, and quantity should also be matched.
Okay, so I say amounts plus quantity. Now is it fine?
Sir, amount here means that agreed price.
Yes. Now you are talking about agreed price. So PO will contain quantity and price plus amount. This will contain only quantity. Again, this will contain quantity, price, and amount. So what you need to do is you need to take all three quantities. So three quantities will be there. Here, two amounts are there plus two prices are there. What if, let's say, for example, if I exclude the price, let's say there's a PO of X, this is an item, okay? X item was supposed to be purchased 100 kg at rupees, let's say 2 per kg. So total was 200 rupees, hypothetical example. And there was a Y item which was 50 kg at, you can say again, at let's say 4 rupees per kg. Okay, and it will give you 200 rupees. So you have a GRN of 100 kg of X and Y being 50 kg. Fine. Now you have an invoice. In invoice, what is done is instead of 2 kg for 100, what he did is 100 kg. Instead of 2, he charged rupee 1 per kg. And you have 100. Now for Y, which is 50 kg, somehow he charged more over here. He charged 8 rupees per kg. And you have now 8 into 50, that is 400. Okay, or something like that. 400. He gave a discount to you of 100. So somehow, coming back to the price at the 400 rupees total. So your amount is matching. Over here is also 400. Amount is matching, but your rates are not matching. This will create a problem later on when if there is a return. If someone is returning this one, at that point in time, it will become a problem. Or let's say, for example, someone is returning this one, it may become a problem, something like that. He may reverse the discounts, or a lot of things can be an issue. So price, quantity, amount, all the threes are required to be matched. Sometimes a biggest mistake which is done is PO is sent to XYZ Limited. GRN, you don't have generally, information from where the goods come. You only have a warehouse or some party details from goods came. It can be from the third party supplier directly, somewhere else is goods coming to you instead of from where you are purchasing. Let's say invoice is being received from XYZ, uh, let's say XYZ A Limited, some different company. They have mentioned the PO number of XYZ Limited. Is it fine? You issue to a one particular supplier, invoice is coming from different supplier in the name of different supplier. So these are some things that not only three-way match, amount, quantity, price, name, all these things are being matched or not. This is the design you check. When I'm checking all these things, this is the design effectiveness testing. Whether design is effective, the control, does the control check these all these things or not? This is the DE testing I'm talking about, design of each control, whether the control is appropriately designed to address all these issues. Now this was design effectiveness. Now tell me, what is operating effectiveness? What is operating effectiveness testing?
Sir, we will check in detail as a sampling, like whether whatever the design is, it is operating appropriately or not. Like we will take some PO as a sample, and then we will check whether it is approved appropriately or not. And when it is payment is done, so whether the payment is done by checking all the things like amount, means all the three-way match, amount, quantity, price, all the thing matching has been done or not. So checking of that in a real time is known as operating effectiveness.
Absolutely correct. I will check samples for that, whether the control, the way it was designed, being actually followed on the ground or not. Now, after design and operating effectiveness testing, let's say design was good. Okay, I have a good design. I have a good operating effectiveness. So now tell me what will be the control risk? I have an inherent risk. Let's say, for example, there is an inherent risk which is high. I say design effectiveness is fine, operating effectiveness is fine. So what could be the control risk now? Simple. Umbrella don't have that much segments from where the water can come. It is low. Yes or no? Your design, that's the size of umbrella, is fine. Operating effectiveness. Actual at the time of rain, the design works. The water flows from the side. It does not come on the person who is holding the umbrella. So at the time of rain also, it does a good job. Means the control risk is low that the water will fall on that person. There are very less chances on that of that. Yes or no? Although you are living in Mumbai, you have an inherent risk is high, but your umbrella is perfectly fine. There are very less chances that you will get wet. The person will get wet. Yes or no?
Yes, sir.
So now, based on these two combinations, I will get risk of material misstatement. Because my inherent risk is high, but the control risk is low, the risk of material misstatement will somewhere lie in between medium. I do have an inherent risk. I assume that. I say that, okay, there are high chances of rain, but the umbrella is of very good quality. So there is very, there is a moderate or you can say, somewhat near to low chances that I will get wet. That's the risk of material misstatement. You will evaluate by understanding the control, and for that you need to understand the control, the internal controls, how they are placed within the organization. Now when I talk about placing the internal controls and everything, see here, we will go and see this example, this particular control example. We said this is a control. Send purchasing manager for approval. The purchase order was sent to purchasing manager for approval. That is good, very good. Now tell me, at this is a very critical question I'm asking. At which assertions this control is addressing the risk? Because the risk is at the assertion level. I should be aware that this control targets this assertion or these all assertions. So at which what are the assertions do you think this control is addressing?
Occurrence cutoff.
Okay. Occurrence and cutoff. Accuracy. Okay. Okay, what about this three-way match? What about this three-way match? What all assertions are being catered by this three-way match control?
In three-way match, we are checking about completeness and accuracy.
Completeness and accuracy. Okay. Completeness and accuracy of which financial statement line item? Inventory?
Yes, sir.
No, it's not inventory. How can you check completeness of the inventory? By checking the purchase transaction. Think. See, completeness of the inventory is something that I purchased the inventory. I have a receiving report. Inventory went into the warehouse. Perfectly fine. Three-way match recorded everything. I made the payment. After that, someone stole the inventory from my warehouse. The warehouse manager stole the inventory. It's not there. How can you then say that three-way match control is giving you comfort over the completeness of inventory? It will not. So the control, like as I said, it is the process of purchasing. So you can say it may give you comfort on the accuracy, on the existence or occurrence. Basically, in purchasing we have a occurrence. Accuracy, occurrence, cut off to some extent. Okay, so these are the assertions where I can get a comfort. Accuracy, cut off, and occurrence. Now the question comes, why not completeness? Why this control is not catering to completeness of purchase also? Can anyone tell me? Why this control does not cater to the completeness of purchase? I said it does not. Can anyone tell me the reason why? After having three-way match control, there's a high risk that the purchases are not complete.
Sir, completeness is not checked because of the purchase on the purchase order once is approved. See, if it is ordered, then only it will come into the completeness. After that, receiving that from the vendor, then on the receipt of GRN, on the invoice, then their end is the completeness. The purchase on the initiating the purchase order itself is not saying the completeness.
I'm saying three-way match. Let's say if there is a three-way match control, why that will not address to the completeness? Let's say purchase order is done, GRN is done. Why three-way match will not give me comfort on completeness? If let's say the item is received by the entity, still I will say that three-way match will not give me a comfort. I'll tell you a simple classic example which happens. Purchase order was raised on, let's say, 1 1 2024. That is the financial year 23-24. Okay, financial year 23-24, when the purchase order raised. Sometimes they have a very big purchase order for the entire period. Let's say this purchase order was valid for 1 year. Now in front of purchase order, you can have multiple invoices. Fine. I have an invoice, or let's say goods received. In front of this purchase order, some of the goods were received, let's say, 4/4/24. Now this has a financial year of 24-25. Perfectly fine, not an issue. And let's say this purchase order is valid till 1 year. I received all the invoices which were done against this purchase, all the invoices. Supplier somehow was careless, not following the appropriate process, or what he did, I don't know. But all the invoices were received on 1/5/25, which is the financial year 25-26. Now in FY 24-25, how three-way match will ensure completeness. Will ensure completeness. See, for three-way match, you need an invoice. Invoice were never received in FY 24-25. But the goods were there. PO was already issued. Goods were already issued. Goods were already received. PO already issued. We have an obligation to pay. Let's say, for example, these goods which were received were sold also on the same year. Without cost of goods sold, without recording invoice, can you show sales? But you sold these goods because you already received on 4/4/24. Let's say these were also sold on 1/7/24. Now tell me, how will you record? You will record sales? Fine. Can you record COGS in front of that? Can you record purchase? Then
No,
how
sir.
three-way? Yeah. In that case, how three-way match is giving you comfort on the completeness? So the three-way match over here is targeting, fine, accuracy for the transactions where you have all the three things: PO, GRN, invoice. I can, I'm happy with the accuracy of that. I can say cutoff. Reason because when I get an invoice, I can validate the cutoff of that. Perfectly fine. Three-way match will help in that also. So any invoice which is recorded will be ensured for the cutoff. Fine. To some extent, I get a comfort on the cutoff. Existence or occurrence, because I have a GRN, I can say that whatever I'm recording, I have the occurrence of that. So transaction is recording. And for the inventory, I have the existence. And for the inventory, this same control give me comfort on the existence and rights and obligations because I have to pay. Same for the accounts payable, whatever I will record, some comfort for the rights and obligations I can get from this control. So three-way match will not only cater to the purchase, to some extent inventory, to some extent account payable, but it will not cater your completeness at all. For that, you need a separate control. Control which monitors open GRN, open PO. Open GRN means which are yet to be matched under three-way. Open PO means for which GRN are yet to be booked. Valuation. Three-way match will never tell you about the valuation of inventory. Yes, he can talk about the accuracy of the invoice. But again, the question comes is, if I cannot ensure completeness, what about the invoices which are not booked? What about the accuracy of those invoices? What about the cutoff of those invoices? What about the occurrence of those invoices? Accounts payable. Again, three-way match will not cater the account. You have not booked the account. Like let's say, for example, you don't have the invoices. Then you don't have the account payables. How can you take comfort for the invoices not booked through three-way match? So in sense, this three-way match is catering to accuracy and cutoff and occurrence to some extent, not fully. So by testing this control or by relying on the outcome of this control, you cannot say that, okay, my risk is fully mitigated now. No, risk at the assertion level still exists for the transactions which are not passed still through the three-way match. You need some other controls to take a comfort on the risk of those transactions. That's where the control risk mapping comes. A risk can be satisfied by three controls. Perfectly fine. Three-way match. Here you can have open GRN review, open PO review. If you have these three controls, they will cater to different assertions, and this how you can address the risk at the financial statement and the assertions level. So by understanding what risk is there in front of which control at the assertion level will give you understanding of how much the risk is there. For example, if you tested this control three-way match, perfectly fine, working very good, but these controls are missing. Open GRN review is missing. There is no such control in the entity. Now the question comes is there a control risk for your completeness? To some extent, accuracy and the cutoff for the invoice is not yet recorded. You will say, yes, definitely. There is a high control risk because the control itself missing. And if I say there is a high inherent risk, high control risk, you have a risk of material misstatement, which is very high. So there are chances that there are invoices which are not booked, but the goods have been received and already sold. This is how the risk assessment and understanding of the internal control is done in actual. Any doubts?
Sir, in this example, I have a doubt. Like during the year financial year 23-24, there are only two-way match can be done. Three-way match cannot be done because invoice is not available. No?
Financial year 23-24. There will be,
Yes,
see,
sir.
if you have received the goods in that year, two-way match can be done. So open GRN review can give you an answer whether the goods were received or not, and you should book a provision for that purchase or not. Provisional purchase. So that depends upon GRN. See, PO, open PO, where you don't have, where you have not received any goods, it is just a contingent liability kind of thing. Or it's a liability which will get materialized in the future. It is just shown by way of a note that okay, we have this much open PO obligation. It's a contractual liability. Sometimes the POs are of such nature you cannot cancel once being issued. So you have a contractual liability which you need to satisfy in future.
Sir, I have more doubts.
Hmm.
Like for computation of risk of material misstatement, so only high, low, medium is taken, or any value is assigned for that for inherent risk or control risk, or
See,
if value assigned, then how the value is decided.
uh, see, it's not like high, medium, and low is the only preferred method. Some people rate from 1 to 5, 1 being very low, 5 being very high. Some people take a rating of 1 to 10. That totally depends upon the methodology that they are adopting, that how to determine a number, how to determine a rating. Why I take the example of high, medium, low? It's very easy because let's say for example, high can be something from 7 to 10, medium can be 4 to 6, and rest of 1 to 3 can be low. So some people take some example like this way, like it depends upon, you can have a different one. You can high, you can have a low medium, you can have a medium medium, high medium, high high, something like that.
And so this design effectiveness and operating effectiveness that we are checking, it is a test of control or it is test of detail. Like in operating, if we are testing in detail, no, means we are checking based on sample. So
See,
whether it is.
so operating effectiveness is the test of control. When I talk about operating effectiveness, this is the TOC that we are talking about. When I talk about design effectiveness, it is the understanding of the internal controls. You understand the internal controls at that point in time. And when I talk about TOC, it's the operating effectiveness.
Okay, sir. Clear. Thank you.
And in a simple terms, if I talk about, so I have DE and OE. I cater the DE when I apply SA 315. That is understanding the entity and its environment through internal controls. That is where I perform the DE. When I comply with SA 330, I am designing a response to the assessed risk. Over there, I am doing the operating effectiveness, which is kind of a TOC. Let's go back to the study material. See, again, like internal controls. Okay. So we understood the internal controls. These are the internal controls are again the process designed, implemented, and maintained by management, those charged with governance, with an objective with respect to the effectiveness and the efficiency of the operation, safeguard of the assets, compliance with the applicable laws. Depends upon the type of internal control and on which process it is. Okay. So when you talk about effective operations of internal control, you need to think of how they were applied. Okay. Consistency, that is operating effectiveness, by whom they were applied, like who were involved in that. So design operational effectiveness is something that you need to understand. Then you have a nature, scope. Like scope will be, on which area the internal control is, what includes in the internal control. Okay. uh, what are the objectives of internal control, how the internal control system is designed, and what are its objectives. So when I say a system of internal controls, the objective is authorization. All the transactions should be authorized, like manager approval, promptly recorded, like they should be recorded in time, safeguard from unauthorized access or use or disposition. For example, only three-way match. Once a three-way match is there, then only you can record it. Safeguard is there. Okay. And verified at the reasonable intervals. Appropriate action is taken with respect to discrepancies. Let's say if three-way match is not getting successful, means you got an invoice which is not matching with your GRN and PO. Will you book? If you have a three-way match control, that will not allow you to book the invoice. Yes or no? So if I have an invoice which is not matching with my PO or GRN, it will raise a flag. There is some issue. I will not this book this invoice. Get it cleared. Get this issue resolved first. Why it is not matching? So verifying the discrepancies, up taking appropriate action when you identify something unusual, a risk basically. So that is one of the part. Limitations of internal control. Basically, see, when I talk about limitations, it's same. We have already seen one of the very big limitations, that is the management override of control. This is a very big limitation which we studied in essay 240 at the time of risk of fraud. Remember? So one such risk is management override of control. There are certain other also limitations. For example, design is such a way, cost effectiveness, a lot of things are there. For example, in this our scenario, I'm talking about open GRN review. What if the cost to implement is, let's say, for example, more than 1,000 crores, because systems are such that they cannot have this kind of control. To have this control, I need to upgrade to some other ERP, for example, SAP or Oracle, and the cost of implementation is 1,000 crores. Will you go and implement? The cost benefits analysis that we will have to do, or the management will do, to understand, like, should we do this implementation of this control, or is there any other way? So this is a limitation on the part of control. So there are certain limitations accordingly. Okay. Management consideration, cost effectiveness, possible circumvention of internal controls, collusion with employees. So these are certain scenarios where you can say internal controls also have a limitation. And the structure of internal controls is, it can be segregation of duty, maker checker is different. It can be authorization of the transition. Transition is authorized, then only it will be processed. Adequacy of records and documents means three-way match. Transactions will be matched, recorded, are the documents appropriately or not. Okay. Accountability and safeguard of the asset. These are the controls basically on the inventories or on the asset side, where they are basically designed to safeguard the asset. For example, inventory count, independent checks by internal audit, something like that. You can also have independent checks by the internal audit or external audit as in type of internal control. Now these are some of the you can say type of or objective or structure of the internal control, how they can be structured. Okay. uh, Apart from that, like, there could be multiple kind of internal controls, multiple type of internal controls. So classification of internal controls is there with respect to, it can be classification with respect to processing, classification with respect to you can say a type of IT involved in that. So if I talk about, let's say, internal controls can be automated, semi-automated, or when I talk about semi-automated, they are the IT dependent manual controls or manual controls. So either can be fully automated, it can be IT dependent manual controls, or it can be manual controls altogether. Plus they can be preventive, detective in nature. When I talk about detective in nature, that means they are the controls which starts once the transaction is processed. Once everything happens, then someone reviews the transaction. That's a detective in nature. Preventive is before booking the transaction, someone is reviewing the control or someone is reviewing the documents. So automated, semi-automated, manual, IT dependent controls also can be kind of, application controls, controls at the application level, business process control, controls at the business process levels. Okay, application, this is kind of IT controls, IT application controls. ITGC controls, that is at the IT general controls in that particular organization. Okay, and then you have entity level controls, ELC, which are operated at the top entity level. Like for example, monthly balance sheet review, monthly P&L review. So controls can be of various types: preventive, detective, application, business process, ITGC, entity level, manual, semi-automatic, automatic. A lot of things can be there. So there can be these type of controls and the combination of the type of controls which can exist. And you can only understand in these types once you go and understand the control. Clear? Any doubt till now? Any doubt? Okay. If no doubt, tell me, how do you understand the control? Like in this example also, how did we understood the control? Like what is happening, how it is happening, how we got that knowledge, from where you can get this knowledge, and how you can get this knowledge, or how you can get this understanding. How you can get this understanding of the control.
From discussion with the management.
Okay. From discussion with the management. Okay. So if let's say management is telling you something, you went to meet to management, management started explaining you everything, and what you will do, let's say for example, I'm there, I'm explaining, just explaining, I'm providing all the verbal informations. Will that be sufficient for you?
No, sir, there should be some document also, like segregation of duties.
Okay. Let's say management does not have any document for that. What you will do? How will you understand the control in that scenario?
In that case, only discussion is optional, sir. We will discuss like for approval of purchase, what who approves and how they approve, for the payment who are approving, all those things. But it's only we can understand, and then we can write down, and then we can take a confirmation from the management on that note, whatever they have said.
Very good. So you will write it down. Okay. Now, when I talk about writing down, uh, one method is this creation of flow charts. It's easy to understand, correct? When you have a flow chart.
Yes, sir. It will be very easy.
Correct. Second method is descriptive. Like like before also we have seen a descriptive process. Like instead of flowchart, you have everything written in words. That is also easy to understand. Yes or no? So
Yes, sir.
flowchart, descriptive, or you can say questionnaire form also could be there. Who processes, what happened next, or a lot of things. So if it is a descriptive, it can be questionnaire, it can be SOP. SOP is nothing but the standard operating procedures document. Flowchart can be flowchart. So these are some methods through which you can understand the internal control and the business processes. So flowchart, questionnaire, SOP, these are the things that management will provide you. Checklist, sometimes if they have a checklist, they will provide you to explain or make you understand the internal controls. And by the help of these, you can understand the internal controls. So you also have these technique to evaluate the internal control. One is a questionnaire, like you ask questions, you get the answer, you write it down in question answer form. Second is a checklist. Remember, we discussed the topic FSCP, that is a financial statement closure procedure or checklist. Financial statement closure checklist also is there, like what they need to do at the end of the financial statement closure period. Checklist form. They can also give you a
Yes, sir.
checklist. Then flowchart. Just now we discussed flowchart. You can understand with the help of flowchart a particular control. So examples are given. I would recommend you to read this. Okay. And then based on that, you can understand what are there in the control or not. And with this, you can also get a document called SOP. That is standard operating procedures. Basically, I'll show you. Yeah. SOP is a document which is kind of verbatim of the flowchart written. So when you assess the internal control, you can also refer to SOP. Clear? Any doubt with this? Any doubt?
Sir, these all assessment related to internal of this design effectiveness and operating effectiveness. These all will be part of audit program and overall audit strategy. That also.
See, overall audit strategy might not be, because till that time you don't have information that how management is going to provide you that this detail. At the time of audit program, you are already aware about, then only you will verify the audit program. In plan, yes, you can include that, okay, how we are going to evaluate the internal controls. The overall view, like, okay, we will take the SOP or flow charts. But when it comes to the program, at that time, you actually take and go through that particular SOP, flow chart, and then fill up the program document.
This program is prepared after conducting this evaluation of operating effectiveness.
Simultaneously.
Okay. Okay,
Simultaneous.
sir.
The moment you read one process, you fill the program. On the basis of that program, you read the other process. Here and there, continuous goes on. Any doubt with respect to any of the part? Okay. If no doubts, what I want you guys to do for the next session, read this chapter, come up with your doubts. Important is to read the chapter, because whatever I have explained, we have gone through the study material, but still your reading is required so that you can have a good understanding of the topic. Once you will read, we will be able to then discuss if you have any doubt, or if I will discuss the further rest of the part of this chapter, you will be able to understand if you have read that. So read, that is very very important. Okay. And practice the questions till that portion we have discussed from the below knowledge questions which are given in this study material, so that you can understand how to answer. We will also take up some question in the next session where we will discuss how to answer the questions for this particular chapter. Okay.
Sir, can you explain about round tripping? It is?
Round
Round
tripping.
tripping. Yes, sir.
Can you like tell me more information where it is the thing you have
It
heard?
is, sir, in chapter number 3, test your understanding, question 3.
Let me open. Test your understanding. Question number 3.
Age is
AN com
3.16, sir. Yes, sir. CA
3.1.
3.16.
Round tripping. Okay. In context of the FEMA. Okay. See, what is a round tripping? Basically, you send the funds outside India for the investment. That entity that you create outside India again back, invest in India through your funds. Round tripping. You send the funds outside, they send the funds again back to India for investment. So how it is shown is first you make investment outside India, and then to take some FDI benefits, they make the investment again back in India. So this is kind of a round tripping. The funds which are going out are coming back to India, just changing the color.
Okay, sir. Got it.
Any other doubts? No? If no further doubts, then I propose to keep the session till here. And please read, practice. These are the two most important things that you need to do. Trust me. Okay. Then thank you guys. Thank you for participating in today's session. I will see you in next session. Thank you.
Thank you, sir.
Thank you. Yes, sir. Thank you.